Hey everyone, me Kevin here. I have come to the realization that Jerome Powell and the Federal Reserve are just the Barrows brothers, ready to kick our ass. And I think that's exactly what's going to happen in November. The Federal Reserve cannot afford to loosen any of their talk on inflation. And in this video, I'm going to show you exactly why, and I'm going to show you what to prepare for, because it's not quite yet what we're expecting. This video, by the way, brought to you by Ritual, but more on them later, and of course we'll have the little bar along the bottom in terms of timestamps. Okay, folks, listen. This morning, something came out known as the Employment Cost Index. It comes out every single quarter. It came out at expectations at 1.2%, which is an indication of how much employment costs are rising. And personal spending came in a little bit hotter than expected. Not so great, probably people spending money over at Apple, honestly. But take a look at this chart. What I want you to know about this chart is extremely simple. The chart shows that, yeah, quarter over quarter, since actually Q1, we have a declining trend here. Q1, we have a peak at 1.4, 1.3, now 1.2. That's great. We're seeing a declining trend in ECI. But look at that ECI chart relative to where it has been over the past 12 to 14 years. It is almost twice, if not 3 times as high as its average of 0.4 or 0.5. That means the Fed cannot risk saying, oh, it went down, we're Gucci. No. They need to continue paying. And this is why when November 2nd comes around, I'm not expecting much belief that Jerome Powell is ready to talk pivot or pause by any means. Maybe we'll see talk about 50 BP rather than 75, but that is still hiking. That is still moving in a tightening direction. And we're not quite sure how long that'll last. Most now think we'll go to 5%. And I'll tell you exactly why we'll go to a terminal rate of 5% rather than this belief that we're going to cap out where the SEP, the Summary of Economic Projections, shows a cap out at 4.6%. The reason I believe we are actually likely to go to 5% rather than peaking at 4.6% or anything even below that is very simple. This chart right here. This is a chart of 5-year break-even inflation expectations. And I'll tell you the absolute worst thing that the Federal Reserve could do is motivate inflation expectations to continue to rise like this. We did a really good thing after the Jackson Hole Symposium that took place at the end of August. Look at what happened to inflation expectations. Jerome Powell not only crushed the stock market, but he made it so freaking clear that this inflation fight will not end, that he successfully massaged inflation expectations down to a near all-time low that honestly we hadn't seen since about the peak of inflation expectations in 2018. That's right, the trough here, the bottom, okay, is basically the peak we saw in 2018, which is kind of pathetic because if we just look at this chart, it's like, oh, that looks good. But when you put it into that perspective, it's like, oh, that's not good because in 2018, Jerome Powell was hiking rates to the point where Donald Trump threatened to fire him. But folks, look at what has happened just on this idea that the Fed is going to go soft, that the Fed's going to loosen their regressive posture. Market expectations, driven by the bond market of inflation, have started rising again to levels not seen since really before the Jackson Hole Symposium. That's a problem, and in my opinion gives cannon fodder to Jerome Powell to say, I must be strong during this next meeting. Now, what I'd like to do next is go through this Goldman summary here on some of the things that have been said and some of the red flags that we need to pay attention to at the Federal Reserve. These also give some pretty critically important expectations. Let's get into those right now. But first, I want to thank today's sponsor, Ritual. Ritual is a transparent multivitamin and a well-researched solution to maintaining a balanced diet. In an ideal world, multivitamins just don't exist. Ideally, we get all the vitamins and minerals that we need within our diets, but oftentimes less is more, and instead of focusing on how you can maintain the perfect diet, it's better to trust the experts who have done the research for you. Essential for Men is an extensively researched multivitamin that helps fill the nutritional gaps in a man's diet. And best of all, they show you every single ingredient, every supplier, and every study that goes into their vegan-friendly multivitamin. Ritual also has omega-3 DHA, which is an omega-3 fatty acid. Super, super important. Plays an important role in helping support brain health, heart health, and eye health. However, unfortunately, this is something that many of us fall short on in our regular diets. And for obsessive label readers, Ritual is vegan-friendly, non-GMO certified, and gluten-free, formulated without any major allergens. And unlike other subscription-based companies, Ritual is just as easy to start as it is to end. It takes about $1 a day to have essential nutrients delivered straight to your door. So go to ritual.com/20kevin or click the link in the description. Use that code 20kevin for 20% off your first month of Ritual. So if you want to get 20% off, 20Kevin. Again, that's ritual.com/20Kevin, or just go to ritual.com, use that link down below, and make sure you put in that coupon code 20Kevin. Welcome back. So here are the things to pay attention to. I highlighted the important comments on the left. They give you a date and then the speaker name if you want to see. You could see that there as we go through it. Important things are that, look, yes, at some point, we're going to pull back from 75. But I think it's a mistake to think that 75 means the Fed is not likely to be more aggressive than expected. Remember, the Federal Reserve's expectation is we're going to cap out at 4.6%. And the market seems to roughly agree with this. However, most Wall Street expectations are actually suggesting the Fed is going to have to hike to about 5.0% before they pause. And that is potentially expected to be around March of 2022. And we've looked at some prior data that suggests Treasury yields tend to peak out about 2 to 3 months before the peak, which would really imply that a peak in Treasury yields is actually still ahead of us and not behind us, even though the 10-year Treasury has softened on some recent reports on this idea that the Fed's going to slow down to 50 basis points. I think Jerome Powell's speech is really going to drive these rates right back up, because so far we haven't really had any data to say that, oh yeah, things are getting better. In fact, they're just relatively stable. And this is why you see comments about a lack of progress on curtailing inflation. Here's Kashgari. Kashgari tends to be a little more dovish, saying, I don't see why I would advocate it stopping at 4.5 or 4.75. We need to see actual progress. That's a 5% comment right there for you. Now, Bullard says we got to get to some minimum level. He's a little bit more hawkish, and then you become data dependent. So he's basically saying we're not there yet. Just keep hiking, and then we'll worry about the data. Mester says, look, high inflation persists, an indication that we need to raise rates further. Charles Evans comes out and says, look, overshooting is costly, and there's uncertainty about how restrictive Fed policy must become. But I'll tell you, probably one of the most important comments is right here. Mr. Bostic saying, therein lies a risk of repeating the stop-and-go approach of what contributed to economic instability in the 60s and 70s. This is where basically the Fed had this on and off approach to raising rates, and they gave so much confusion to markets about, okay, so are we pausing, are we raising, are we slowing, what are we doing? There was so much confusion and uncertainty that the Fed lost so much credibility that what ended up happening was inflation expectations anchored, and they became so bad that we ended up with the 70s where inflation expectations were so high that we had to get Paul Volcker. The last thing we want are inflation expectations to rise. And this is exactly what's happening right now, is inflation expectations are rising. This means the Fed has to be crystal clear. The Fed probably has to rug pull us next week, and they have to be really strong, at least for another couple meetings, and make sure that markets don't doubt the Fed's seriousness of waiting until inflation actually starts showing meaningful core evidence that it has peaked. And I hate to say it, but when we look at actual commentary here, again, Kashgari, core inflation has not yet shown evidence that it has peaked. Now, many say, look, rental inflation is just a laggard and that it has already peaked. But then you've got people like Bullard saying, look, I don't think rental inflation is going to be persistent. But then you've got individuals like Bullard coming out and saying, I actually do think that rental inflation is going to be persistent. It's widespread and it's going to be persistent, and that's why we're going to have to be higher for longer. The war in Ukraine continues to move on. The last thing we want, as said by Cook, is that inflationary psychology to take hold like we saw in the 70s. Shelter inflation likely to remain high for several months, and services prices continue to rise at a fast clip. This one particularly by Bostic saying, I continue to hear a very strong demand for in-person services like restaurant meals. I'll tell you this, I was reading, and we'll go through this in the course member stream this morning. I was going through the Chipotle earnings call, and I'll tell you, they are still seeing the power to raise prices. The only people unable to actually continue going to their store are poorer people. But otherwise, the people who continue to go to Chipotle, who have got a little bit more money, they continue to accept the pricing that Chipotle provides. And that's a sign that even with their recent price increase in August, that inflationary numbers are still going to trend up. It's just not good. Now, hopefully, there's this hope from Williams that inflation will decline to 3% next year as we rely heavily on commodities, which are showing indications of having peaked. But unfortunately, I don't think any of the data that we've recently gotten, whether it was the PCE inflation numbers that came out this morning or the ECI, give any credence to this idea that, oh yeah, Jerome Powell's going to go soft on us in this November meeting. I think it's much more likely that Jerome Powell has to come out and talk these inflation expectations down. Then, 2 days after their meeting, we're going to get an employment report. And then shortly after that, we're going to get a new CPI report. So within 2 weeks after the next Fed meeting, then we're actually going to get jobs data and inflation data. And then after that, if we look at the FOMC meeting calendar, we're going to have the December meeting. Now, the December meeting is kind of neat because, see, the December meeting happens on December 13th and 14th, and we get a new summary of economic projections. Now, why is that so important? Well, because, again, the November numbers are going to be based on data that we currently have, which is not good, and inflation expectations are rising. This is going to be a bad meeting, in my opinion. The beautiful thing about the December meeting is going to be a little different. We're going to have data for jobs that comes out on November 4th. We're going to have jobs data that comes out on the first Friday in December. And you could write those things on your calendar, okay? November 4th and the first Friday of December are going to be the jobs reports coming up. And then CPI reports are going to come out on November 10th. Notice that's after the Fed meeting by about 8 days. And December 13th, which is literally the morning the Fed meeting in December starts. So going into November, we really get no good news. Higher inflation expectations, no good news. Going into December, we actually get 2 jobs reports and 2 CPI reports. So, December is the meeting that's probably going to make or break markets. If these next 2 reports show real, meaningful declines, we're going to the frickin' moon for Christmas, boys and girls. If we get some dirty numbers of these next 2 reports, get your anti-venom potions ready because we screwed. Anyway, thank you so much for watching. Good luck out there. Use that Halloween coupon code. And folks, we'll see you soon. Goodbye.